Investing for Beginners, 5 Easy Steps to Get Started. Hey there, future Warren Buffetts. Ready to dive into the world of investing but don't know where to start? Well, you're in luck. Today, we're breaking down the basics of investing into 5 simple, hilarious steps. Let's get rich, or at least have some fun trying. All right, let's talk about time. No, not the kind that makes you late for work, but the kind that makes you money while you sleep. The kind that works for you, even when you're not thinking about it. See, investing is like baking a cake. It requires patience, the right ingredients, and a bit of know-how. You wouldn't throw all the ingredients in at the last minute and expect a masterpiece, right? You need to follow the recipe, measure carefully, and give it the time it needs. You gotta give it time to bake, to rise, to become something beautiful and delicious. Rushing it would only lead to a mess. Investing is the same way. It's a process that requires time and patience. The earlier you start, the more time your money has to grow. It's like planting seeds in a garden. It's like planting a tree. The best time was 20 years ago. But the second best time is right now. The sooner you plant, the sooner you can enjoy the shade. Think of it like this. If you invest just $100 a month starting at age 25, with an average return of 7%, you'd have over $1 million by the time you retire. $1 million. That's the power of compound interest. Now, I know what you're thinking, Graham. I don't have an extra $100 a month. It seems impossible, right? And you know what? That's okay. Every little bit counts. Even small amounts can add up over time. Even if you can only swing $20 a week, that's still $1,000 a year working for you, growing, compounding, and turning into something amazing. It's about consistency and commitment. The point is, don't wait. Time is your best friend when it comes to investing. Don't be that person who says, "Oh, I'll start investing when I'm older, when I have more money," because that day might never come. Because guess what? Life happens. Unexpected expenses pop up, you get a sudden craving for avocado toast every day, and before you know it, years have gone by, and you're kicking yourself for not starting sooner. So, do yourself a favor, future millionaire, start today. Don't let regret be part of your financial story. So, do yourself a favor, future millionaire, start today. Even if it's just a small amount, it's a step in the right direction. Even if it's just a small amount, it's a step in the right direction. Every journey begins with a single step. Remember, the only bad time to invest is never. So take that step and let your money work for you. Okay, so you're ready to start investing, but how much should you actually put in? Well, I'm not going to tell you to live off ramen noodles and invest every penny you have. That's just crazy talk. Investing should be a part of your financial plan, not your entire financial plan. Think of it like this. How much do you spend on coffee every day? $5? $10? Now imagine taking that same amount and putting it towards your future self instead of a caffeine fix. That's right, we're talking about investing your coffee money.
But Graham, I need my coffee. It's what gets me through the day.
And you know what? I get it. I'm a big fan of coffee myself. But think about it this way. Would you rather have a temporary caffeine boost or a lifetime of financial security? The key here is to find an amount that you're comfortable with. An amount that won't leave you feeling deprived or stressed. Start small, maybe with that coffee money, and gradually increase it as you get more comfortable. Remember, it's a marathon, not a sprint. And hey, if you can cut back on a few other unnecessary expenses, like that gym membership you never use or those subscription boxes you always forget to cancel, you'll be surprised at how much extra money you can find to invest. Chapter 3. Opening an investment account. Your treasure chest awaits. All right, now that you're ready to start investing, you need to figure out where to put your money. This is a crucial step in your financial journey. And no, I'm not talking about that dusty old shoebox under your bed. That might be good for hiding your secret stash of candy, but not for growing your wealth. We're talking about opening an investment account. This is where the magic happens. Financial advisor. Think of it like opening a secret treasure chest, but with more paperwork and fewer pirates. It's your gateway to financial freedom. Don't worry, it's not as intimidating as it sounds. With the right guidance, you'll be navigating these waters like a pro. In fact, it's actually pretty easy. Many platforms are user-friendly and designed to help you every step of the way. There are 2 main types of investment accounts you'll want to consider: a Roth IRA and a traditional IRA. Each has its own unique benefits. Now, I know what you're thinking, Graham. Those sound like something my grandpa talks about. But don't let the names fool you. And you know what? You're not wrong. These accounts have been around for a while, but they're still incredibly relevant today. But trust me, these accounts are your best friends when it comes to investing. They offer tax advantages that can significantly boost your savings. Financial advisor. A Roth IRA is like the cool kid on the block. It's popular for a reason. You contribute after-tax dollars, which means you pay taxes now, but then all your earnings grow tax-free. That's right, tax-free. Imagine the growth potential. So when you retire and start withdrawing your money, you won't owe Uncle Sam a dime. It's like having a tax-free income stream in your golden years. A traditional IRA, on the other hand, is like the responsible older sibling. It offers immediate tax benefits. You contribute pre-tax dollars, which means you get a tax deduction now, but then you pay taxes on your earnings when you withdraw them in retirement. This can be beneficial if you're looking to lower your taxable income today. Financial advisor. So, which one should you choose? It's a personal decision that depends on your financial goals and tax situation. Well, it depends on your individual circumstances. Consider your current and future tax brackets, as well as your retirement plans. If you think you'll be in a higher tax bracket in retirement, a Roth IRA might be the better option. This way, you can enjoy tax-free withdrawals when you need them most. But if you're in a lower tax bracket now and want to reduce your current tax bill, a traditional IRA could be the way to go. It offers immediate tax relief, which can be a significant advantage. Chapter 4. Picking an investment strategy, tortoise or hare. All right, so you've got your investment account set up. Now it's time to figure out what to do with it. And no, I'm not talking about buying a bunch of lottery tickets and hoping for the best. We're talking about choosing an investment strategy. Experienced investor, think of it like this. Are you a tortoise or a hare? Slow and steady or fast and furious? Your investment strategy should align with your risk tolerance and time horizon. If you're young and have a long time horizon, you can afford to take on more risk. You're like the hare, sprinting towards the finish line. You might stumble along the way, but you have plenty of time to recover. On the other hand, if you're closer to retirement, you'll want to be more conservative with your investments. You're like the tortoise. Slow and steady wins the race. You don't have as much time to make up for any losses, so it's important to protect your principal. Experienced investor. There are a few different investment strategies you can choose from, but two of the most common are growth investing and value investing. Growth investors are like treasure hunters, always on the lookout for the next big thing. They invest in companies that are expected to grow at an above-average rate, even if they're not currently profitable. Value investors, on the other hand, are like bargain shoppers. They look for companies that are undervalued by the market, even if they're not the most exciting or glamorous. Chapter 5. Understanding your investment options. It's like a buffet, but for your money. All right, so you've got your investment account, you've chosen your strategy. Now it's time to figure out what to actually invest in. This is where the fun begins, and the choices can seem endless. And no, I'm not talking about that limited edition Beanie Baby your aunt swears is going to be worth a fortune someday. While collectibles can be interesting, they aren't the cornerstone of a solid investment strategy. We're talking about real, diversified investments. These are the building blocks of a robust portfolio that can weather market ups and downs. Tech-savvy investor? Think of it like a buffet, but for your money. Just like a buffet offers a variety of dishes, the investment world offers a variety of asset classes. You wouldn't just load up on your favorite dish, would you? Even if you love pizza, you wouldn't eat only pizza at a buffet. No, you'd want to try a little bit of everything to get a well-rounded meal. Sampling different dishes ensures you get a balanced diet. Investing is the same way. Diversification is key to a healthy investment portfolio. You want to diversify your portfolio across different asset classes to reduce risk and maximize returns. This means spreading your investments across various types of assets. So, what are these magical asset classes? Let's break them down. Well, there are a few main ones you should know about. First up, we have stocks. Stocks are like owning a tiny piece of a company. When you buy a stock, you become a shareholder. Stocks are like owning a tiny piece of a company. When the company does well, the value of your stock goes up. And when the company does poorly, the value of your stock goes down. When the company does well, the value of your stock goes up. And when the company does poorly, the value of your stock goes down. It's a bit of a roller coaster ride, but over the long term, stocks have historically outperformed other asset classes. It's a bit of a roller coaster ride, but over the long term, stocks have historically outperformed other asset classes. They offer the potential for high returns, but also come with higher risk. Tech-savvy investor. Next, we have bonds. bonds are a more stable investment option. Bonds are like IOUs from the government or a corporation. You lend them money, and they promise to pay you back with interest. You lend them money, and they promise to pay you back with interest. Bonds are generally considered less risky than stocks, but they also offer lower potential returns. Bonds are generally considered less risky than stocks, but they also offer lower potential returns. They provide a steady income stream and can be a good way to balance out the risk in your portfolio. Then, we have real estate. Real estate is a tangible asset that you can see and touch. Real estate is like owning physical property, such as a house, apartment building, or commercial building. It can provide rental income and potential for property value appreciation. Real estate can be a good investment, but it can also be illiquid and require a lot of upfront capital. It's not as easy to buy and sell as stocks or bonds. Tech-savvy investor. And finally, we have commodities. Commodities are physical goods that are used in commerce. Commodities are raw materials such as oil, gold, and wheat. They can be a hedge against inflation and add another layer of diversification to your portfolio. The prices of commodities can be volatile, but they can also provide diversification to your portfolio. By including commodities, you can protect your investments from market fluctuations and economic changes. And there you have it, folks. 5 easy steps to kickstart your investing journey. Remember, it's not about timing the market, but time in the market.
So get started today, and who knows? Maybe one day you'll be the next big thing on Wall Street.
Don't forget to like, subscribe, and hit that notification bell for more fun financial tips.